So the end of year rapidly approaching. Many Americans wind up using this time to do a lot of their charitable giving. And so we thought on this week's program that we would talk a little bit about philanthropy, the fancy term for charitable giving, and really why having a plan versus just kind of randomly writing out some checks at the end of the year is crucially important from a legacy perspective, from a tax efficiency perspective, and even from a family dynamic perspective. So we're going to talk about that on this week's program. Plus, we're going to talk about how to avoid some costly mistakes that we see, unfortunately, all too regularly when people decide to do a rollover of their old 401k to an IRA. If you are uninformed on some of the pitfalls that can occur on that, then you can make mistakes that will cost you a lot of money. So we're going to share sort of the three biggest ones that we see and how you can avoid those. So welcome on into the program to Dollars and Cents. This, of course, is a program where we help you make sense out of all of life's decisions involving your dollars, one of Central Florida's longest-running radio programs, also a top 25 financial planning podcast. If you are not familiar with our podcast platform, well, then go to our website at nelsonfinancialplanning.com. There you'll see all the icons that are most familiar, whether it's Spotify or iTunes or whatever the case may be. We've got a channel on all of those various platforms. Click on the icon. It'll get you redirected over to our channel on that particular platform. Once you're there, make sure you subscribe, and then that way you don't have to go through that process again. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks, all of whom happen to be certified financial fiduciaries as well, along with a host of other acronyms that attest to their expertise. And they stand ready to help you make better decisions with your money. So give them a call. Visit the website at Nelson Financial Planning. As always, our consultations are free of charge, as they have been since we started, or since our business started back in 1984. So this past week, busy week around the office, we had our biannual shred day this past week. And in particular, that coincides with our food and toy drive that we do every year here around the holidays. And so obviously, toy drive to benefit Toys for Tots, food drive to benefit Second Harvest Food Bank. And as you might well imagine, given kind of what's going on in the world at large, that the outpouring was significantly greater than last year. So I want to take a moment and just start the program by saying thank you. Thank you to all who participated, our clients, our friends, and other folks that found us on social media, courtesy of the Shred Day that we have. We do a couple of those during the course of the year, one in December and then one in May. And that the goal of those is to just help you protect yourself by properly disposing of your private information. So a big truck comes on site, goes through the process of shredding it all. But for the December one, obviously the toy and food drive that we do every year at Nelson Financial Planning, really touched by the outpouring of folks and obviously able to gather a tremendous amount of food for Second Harvest Food Bank and toys for Toys for Tots. So we certainly appreciate all of your support. This past week as well, I'm going to kind of affectionately, or maybe not affectionately, refer to it as IRMAA season. And you'll understand why I refer to it not affectionately here in just a second. First of all, what is IRMAA season? Well, it is the time of year when folks get letters from Social Security thinking that their Social Security is going to go up because of the COLA, things like that. But alas, they're told that their Social Security payment is going to go down for the year 2026. Each year around this time, we get a lot of calls about that same subject. The reality is that it's not like your Social Security went down. If you received one of those letters, it's not that your Social Security is going down. It's that the cost of your Medicare is going up. And that happens automatically when your income is above certain thresholds. And so this IRMAA thing, which is an acronym for Income Related Monthly Adjustment Amount, one of the things that always confuses people is sort of the look back on this, right? So the impact is obviously for 2026. It impacts the amount of your Social Security, but it's based on the income picture that you had in 2024. So that can get kind of confusing. And I guess if you stop and think it through, 2024 represents the most recent completed tax year when you're trying to make a decision in 2026 on what someone's income was. So what they're doing and what these letters are all about that were generated to a host of people this past week is that it's looking at that completed 2024 tax return. And if you're above certain thresholds, and these thresholds are not particularly high in the grand scheme of things. If you are single, this IRMAA adjustment can start when your adjusted gross income is above $106,000. If you're married doing a joint return, that income adjustment can start when your income is above $212,000. So what happens is that if you have a year where there's an isolated event, like let's say you retired, or you had a big sick time or vacation time payout, or maybe you had to take a deferred comp payout, or maybe you sold an investment property, all of those things would trigger a spike in income, and then that spike in income contributes to the adjustment or the increase in the amount that you have to pay if you are on Medicare. And there's 5 tiers of this, folks, whereby depending upon where your income is, the cost of your Medicare is going to gradually click upward. And so depending upon how much income you have, depends on sort of what bucket you fall in, and then that drives how much you then have to pay for Medicare. So if you think of it this way, the normal cost of Medicare Part B is $185. There's 5 different tiers beyond that of income that gradually raises that premium from $185 to $259, all the way up to $629. That's per person, by the way, folks. So if you had something that was out of the ordinary that spiked income, you could, in fact, for a couple, see your cost of Medicare go up by $1,000 a month if you go from that 185 to 629 number. Maybe not quite 1,000, a little bit less, but we're rounding up. That's a pretty significant increase in the cost. So be aware of that. And if you got one of those letters, the explanation is not that Social Security went down, it's that cost went up. Now, you do have some options. And so we helped a couple of people this past week kind of work through these options. You can challenge, or should I say appeal, this IRMAA decision. And one of the ways in which you can challenge it or appeal it is that if, for example, there was outdated information on the tax return, or if you had to file an amended tax return, all of that would change the numbers. But more importantly, if the numbers are what the numbers are, there's a few things that generally they describe as life-changing events that if you qualify, you can fill out a form, and it's called the SSA 44. This is the form to kind of challenge the determination that you may have gotten in this letter. And some of those life-changing events include things like retirement or reduction in work, marriage, divorce, loss of spouse, loss of a pension or income-producing property. So there's some things that sort of qualify that if you want to appeal the decision, that you would first complete that form SSA 44. You would gather documentation that would sort of back up why you had that or why that was a life-changing event that caused that spike in income. And then, of course, you would submit your appeal and then, just wait. And you're going to perhaps wait a while, but I guess the good news is if you get denied, you can apply to reconsider. About half of those appeals are delayed or denied due to missing paperwork or just non-qualifying events. But if you got the letter, it's certainly worth taking a shot at the appeal. With that, we're going to wrap it on up and take a break and continue after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Make sure you subscribe, and then that way you don't have to do that process again. And in fact, you'll get notified when we upload new material, as we do each and every week. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. So talking about this past week, obviously Shred Day at the office and sort of a wrap up of our annual toy drive and food drive benefiting Toys for Tots and Second Harvest Food Bank. Certainly want to take a moment and again express our gratitude for all those that showed up and contributed to folks that are in great need, particularly on the food side of things these days. So it was nice to see that we gathered a lot more than we did last year. Obviously, people understanding what is going on out there in the world at large with some of these continuing impacts of inflation. And obviously the government shutdown as well. So that's the week that was. Looking ahead this week, you've got the Fed meeting. They meet on Tuesday and Wednesday. A rate decision then would be on Wednesday. Usually comes out around 2 o'clock, 2:15 on Wednesday. Clearly, as we think about what went on in the market this past week, with sort of that upward trend that we saw. Markets clearly anticipating some type of a rate cut, as evidenced by that sort of upward trend this past week in the markets. As I think about it, it could be, though, that the markets are engaging in sort of that typical behavior of sort of buying the rumor or getting excited about the rumor, meaning, oh, we're going to get a Fed rate cut. That's great. But then when reality hits, it's kind of buy the rumor, sell the news, where it gets excited about the possibility. But then when the actuality happens, the market can continue to say, wait a minute, well, what does all this really mean? And at the end of the day, if the Fed's cutting rates, at least based on sort of fundamental economic theory, if the Fed's cutting rates, that means that there's something that's not totally kosher, totally cool going on in the economy as a whole, and hence you need to reduce rates. So a bit of a double-edged sword when we talk about the Fed cutting rates and what its potential impact might be. We'll see how this week plays out along the way in terms of kind of how that Fed rate decision ultimately impacts the economy and the markets. That is for sure. Speaking of things that can also have a pretty significant impact on what's going on, that is this notion of making sure that you don't fall into some of the traps and frankly, traps that can lead to some pretty costly mistakes when it comes to rolling over your 401k. So this conversation really applies to anybody that's, like in the process of changing jobs or has ever changed jobs, which is, by the way, pretty much all Americans, or about ready to retire. And so typically, if you've got a qualified employer plan, 401k, those types of things, you've got to work through whether it makes sense to roll over that 401k to, in essence, sort of take your money with you. And oftentimes that can be sort of a smart move, especially in today's world of sort of this, we talk about it as sort of this race to the bottom, in that among employer-sponsored plans, kind of those qualified retirement plans, it's this race to the bottom in that every employer in the desire to cut cost is seeking out the cheapest plan option with standard cookie cutter kind of target date funds. And so turnover among these different employer plans is pretty significant. And then the other issue, which we talked about a couple weeks on the radio program, is that if you have a residual balance in one of those 401ks, then it's within the employer's rights in some cases to just send a check, withhold the taxes, send the check, and poof, that's taxable income to you. Or the employer is within its rights to just send it over to an external platform, and ultimately that money then sits there in cash until you elect to do something with. So a lot of issues involving the 401ks and making sure that you pay attention when you leave an employer, whether that's changing jobs or retiring, that you really address it. But there's also some pitfalls along the way, and that's what we kind of wanted to talk a little bit more about today. And the biggest is, when you leave a job and you want to move your 401k, you've kind of got two options. You can do it as a direct transfer, which is obviously the safest route. Unfortunately, in that case, there's usually some paperwork. You may have to track down a notary, or even harder to track down a signature guarantee for that paperwork. But if you go through that process, that's definitely the safer route to avoid any types of tax implications, because then when the money gets distributed, it's made payable to that new custodian, that new IRA, that new 401k, and you're not going to have to worry about any of the tax implications. Things get much, much harder if you decide to go the easy route and say, oh, just send me the money and I'll deal with it. If you do that, two things are going to happen. First of all, they're going to withhold 20% for taxes because that's the federal rules. And when they do that, guess what happens? You only get 80% of the money, right? Because 20% went off to the IRS, then you're only going to get 80% of your money. That means that in order to complete the rollover of the entire balance, you got to come up with the other 20% out of pocket at that point in time. Now, granted, the amount of money that was withheld for tax withholding, you'll get to put that on your tax return and effectively get that back. But the deal with the rollover is that it has to also be done within 60 days. So if you decide to kind of take the easy option and say, just send me the cash and I'll deal with it, the problem is you've got a limited window in which to deal with it, and then you've got to come up with the extra 20%. Because if you don't, if you miss the 60 days, or if you don't deal with the 20% of the tax that was withheld, if you're under 59.5, there's a 10% penalty on that. And no matter how old you are, it's going to be fully taxable. So just be aware of those issues. Bottom line, in order to avoid that costly mistake, go through the process. Do the proper paperwork. Call your 401k provider, ask them what's necessary. Sometimes they'll be able to do it over the phone, which is easy. Other times it's paperwork, it's notarization, it's all of that. But if you do that, that's obviously the safer way in which to do a rollover of an old 401k or similar type of qualified retirement plan. The second issue, and this one gets overlooked, and because this is a little bit of a unique tax aspect to the accessibility of money inside qualified retirement plans if you are retiring or leaving in the year in which you turn age 55 or older up to 59.5. Now remember, at 59.5, there's never an early distribution penalty on any type of retirement account, so it's freely accessible without having to worry about a penalty. Still got to pay taxes on it, obviously, if it's pre-tax. But with the rule of 55, if you're retiring in the year in which you turn age 55 or older up to 59.5, there's a special IRS provision, referred to as the rule of 55, that allows you to withdraw and use those funds as long as they stay in that qualified retirement plan, and you do not have to worry about the extra 10% penalty that would generally apply if you were under 59.5. So that's a great feature that can sort of bridge the gap between, sort of traditional retirement ages and some early retirement ages. And a lot of folks miss this. And here's the thing. If you take that 401k and roll it over to an IRA, that game over. You've just put the assets in an account where the rule of 55 and that exemption from that 10% early distribution penalty will not apply. We're going to have a little bit more on this one when we return after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running programs, also a top 25 financial planning podcast, along with our YouTube channel. So you get to see that we are, in fact, coming to you non-AI generated out of our Nelson Financial Planning studios. And then because it is December, look, holiday tie with little Santa and reindeer and all that kind of stuff going on. Anyway, hope you have a very happy holiday season. Obviously, on the program, we've been thanking our listening audience, our clients, our friends, and the community as a whole for the outpouring of support that they showed on this year's annual toy and food drive that we've been holding for a number of years at Nelson Financial Planning. Really an incredible outpouring of toys for Tots and food for Second Harvest Food Bank, and certainly appreciate all who participated in those efforts. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we help you make better decisions with your money. So check us out on our website at Nelson Financial Planning. For the break, we were kind of detailing some of those circumstances that we see people kind of falling into, or traps, if you will, that people fall into when it comes to rolling over their 401k. Before the break, we were talking about a couple. The first one is this notion of when you do the process of rolling over your 401k, make sure you do it correctly. Take the time to fill out the forms and the paperwork and all of that, because if you just kind of hit the easy button and say, send me a check and I'll deal with it, well, the clock starts ticking and it's only 60 days until you got to get the money back in. And then, even more importantly, the check that you receive is only going to be 80% of what the balance was, because under the IRS rules, they're required to withhold 20%. So if you want to tax shelter all of it, then you've got to come up with the extra 20% if you are doing the 60-day rollover. Bottom line on that, make sure that you take the time to fill out the proper forms, make the proper calls to have that rollover be a direct rollover from one custodian, one trustee, to another custodian, another trustee. The second thing we were talking about is this rule of 55. Now, a relatively unique exception in the IRS code that says that if you retire in the year in which you turn age 55 or older, so the particular applicability to this rule is sort of between the year in which you turn age 55 and age 59 and a half, because at 59 and a half, the early distribution penalty, which is an extra 10% penalty on top of any tax implications, that goes away at 59 and a half. So this rule is really specific for those that are kind of looking at early retirement. And you've got to be careful with this one, because here's the kicker. If you take your 401k, roll it over to an IRA, then you lose the ability to take advantage of this exception in the IRS code. Why? Because when you put your 401k into an IRA, then the IRA rules apply, not the qualified retirement plan rules. So yes, just another way in which our fun-filled tax code is filled with all kinds of nuances and exceptions. This would be one of them, but it can certainly have a pretty significant and material impact, especially if you're looking to retire early and you unwittingly roll over that 401k to an IRA. The reality is then that now you're going to be subject to the IRA rules, which don't have this over age 55 rule. So that was number two. And then number three, and this one is kind of a really more unique, I'm going to go with convoluted in terms of kind of how it plays out. But this applies to folks that own a lot of shares of their company, their employer, their employer's stock inside their 401k. So think like maybe Lockheed or Disney or whatever the case may be. And here's how it works, and the concept is called net unrealized appreciation. That's a really kind of a mouthful, or NUA if you're into abbreviations and acronyms. But this one is rare. Although what's interesting is it's becoming more and more common. Particularly as folks have longer periods of time where they were exposed to being able to buy shares of their employer stock. So what it is, and it's convoluted, but we're going to try and explain it here real quick on the program. So let's say that inside my 401k rollover, for my 401k, stay there for just a second, I own shares of company ABC. The value of those shares inside my company rollover is $400,000. But the amount of money that I sort of put into that was $100,000. Okay, so I put in $100,000, it's worth $400,000. The net unrealized appreciation then is this $300,000. What the rules allow you to do is, if you take advantage of this exception, if this particular very unique set of circumstances applies to you, then you can say, hey, I'm going to take that stock piece out, and I'm going to put it into a regular investment account, sort of like an after-tax brokerage or investment type of account, whatever you want to call it. But you take it out of the IRA, so it's no longer in the 401k IRA wrapper. When you do that, you have to report and pay taxes on the full amount of the basis. So that means that year you would be paying $100,000, reporting and paying taxes on $100,000. But remember the $300,000 gain. So that $300,000 gain, all of that is now sitting outside of your 401k, your IRA. And now that gain is going to be subject to capital gain tax rates, which are much lower than ordinary income. This is very sophisticated planning and something that we would typically see in the past. Rarely, but there's definitely been an uptick of us seeing this over the course of the past year or so. And so it is very unique. Bottom line, if you have your employer stock position in your 401k and you've worked for that company for a long time and that position has grown, you've got a real option to take advantage of some significant tax planning where you're going to be able to take all of that retirement account or that portion of the retirement account and take that gain and convert it over to regular capital gain tax rates, which, as we know, are lower than ordinary income tax rates. So the concept is net unrealized appreciation, or NUA. If you've got if you've got employer stock inside your 401k, we would encourage you to make sure that you're taking a look at that and seeing whether that might be applicable to you in terms of walking through that strategy that basically would take ordinary income or profit and shift it over to being capital gain profit. Pretty significant difference in tax rates, but one that you've really got to be careful in terms of kind of how you do it, because this one definitely has a specific process. Bottom line, for all of these kinds of questions and issues involving 401ks and rolling them over and how to avoid some of these traps that we've talked about on the program, obviously direct transfer is the best and the safest way to do that. You don't really want to do the 60-day rollover unless that's really absolutely necessary, because if you do take a distribution, make sure you watch out for taxes that are being withheld, or if you're not old enough, you've got an early distribution penalty to apply as well. Don't forget that rule of 55. That is so crucial and really opens up the option of folks being able to retire at sort of earlier ages and not have to worry about an early distribution penalty. And then, that company stock strategy involving net unrealized appreciation. If you've got some appreciated shares of your company, employer, in your 401k, you may really have a tax opportunity that you need to make sure that you're working through very, very carefully. Bottom line, these are the kinds of complex rules involving retirement that we work with people every day at Nelson Financial Planning. And we would encourage you to pick up the phone and give us a call if you think any one of these three scenarios might apply, because if it's done the wrong way, the implications can be pretty costly and pretty significant. So for that, obviously, that's what our website is all about at Nelson Financial Planning. There you can reach out to us and also schedule one of those absolutely free conversations that we have been offering since 1984. Our purpose, as always, is here to help you make better decisions with your money. With that, we're going to take a break and continue after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So this is a time of year when a lot of people make their charitable giving, sit down, write some checks out. Maybe it's the church or charity or whatever the case may be. And certainly a lot of people do that. The concept, though, that we want to talk about with our listening audience today is to maybe have some intentionality to that. Charitable giving, or philanthropy as it's known in fancier circles, is really much more than just giving. There's really some powerful tools that can come into play when it comes to just overall financial planning, family wealth management, family unity, creating a lasting legacy. So in this segment, given the time of year, we thought it would be important to kind of have this conversation with y'all. And unfortunately, we see more and more where there's not really a lot of people in the financial business that sort of talk a lot about this. Not to be jaded, but I've been doing it a long time, so I guess I'm entitled to be a little jaded. Some of that is because if your client is charitable minded and starts giving away a bunch of money, then you, as the finance person, you're going to have less money to manage. And if you're charging based on how much you're managing, then what's the incentive to do that? But hey, you know what? I'm jaded, so don't listen to me. But maybe there's a correlation, because this isn't a conversation that comes up often. The reality is, though, that charitable giving in the U.S. topped nearly $600 billion over the course of the past year. 94% of wealthy Americans are philanthropically active in some capacity, with the average gift coming out at about $43,000 annually. Certainly proof that a lot of families have charitable giving as a primary priority. And the reality is that far too often, charitable giving and philanthropy as a whole is treated as sort of a little bit of an afterthought. And the reality is that the financial services industry really should be focusing on this as a bigger issue, particularly to help people really integrate more when it comes to talking about investments and taxes and estate planning. Charitable planning is a big part of kind of how all three of those can really work together, because charitable planning can obviously reduce taxes. It can strengthen family bonds and even prepare the next generation for sort of leadership to the extent that you're having these broader conversations. And so ignoring it can really, I think, lead to a mischance for you as the individual to achieve sort of broader financial goals than just, I want to retire and, all those kinds of things. So, some of the benefits that come from sort of being strategic in terms of the planning is that you're able to sort of align your charitable goals with your investment strategies. Okay, maybe you've got a portion of the portfolio that you're kind of earmarking for charitable giving. That gives you some opportunities to really think about, okay, well then does this investment strategy need to be the same as the investment strategy that I'm using on this account over here that's generating out for me my monthly retirement income. Similarly, as we know, charitable giving, you get to write off those charitable deductions. You've got to itemize. Next year, there's a new above-the-line deduction that will come into play with charity. But the reality is that if you're giving significant charitable gifts, you should be itemizing anyway to get the full benefit of that. And when you do that, then you've got the capability of minimizing estate taxes as well. Now, obviously, the estate tax exemption is super high, but to the extent that there's changes on that over the years ahead, then I think charitable giving and charitable planning is going to become a bigger part of kind of how to deal with changing estate tax rates. In terms of when you're starting to kind of have these conversations, it also gives you an opportunity to talk to the next generation or the next generation to kind of talk about values and what's important to you as a family unit, the types of causes that you think are important, and ultimately to kind of help impart some of those values and that wisdom across the generation. And by engaging in a conversation about money and charitable giving, it helps to increase the likelihood that you're able to then, sort of teach some family values, particularly if you have other generations involved in the decision-making process of what that looks like from a responsibility point of view, and understand the empathy that comes when you're looking at charitable giving. So I think there's a lot of, beyond just kind of the tax and the estate planning side of things, that the value that can come from this, along with the fact that chances are the organization you're giving money to needs the money to help promote whatever the cause is. There's also a lot of family legacy and values and teaching moments that if you will, that apply to the next generation. So I think the bottom line is to really think about philanthropy, charitable giving as so much more than just simply writing a check, and to really create a more integrated strategy, if you will. So how do you get started on all of this? And we've got a few kind of action steps, kind of takeaways here. First, it starts with sort of defining your charitable mission. Like, what causes matter most to you? What's important to you? Where do you want to see this money be put to use, and what causes or opportunities? And then there's a host of different ways in which you can kind of give gifts beyond just, I'm just going to write a check and that's it. There's donor advised funds, there's private foundations, there's charitable trusts. All of those have obviously pros and cons, just like any type of an investment strategy does, but they definitely expand out the opportunity to give some charitable giving. We're big fans of charitable giving, particularly in years where there's a big spike in income. Typically, if you are selling your business and there's a big spike in income, we often talk to people about maybe doing a donor advised fund, where you make all of the contribution this year, you get all of the tax benefit this year, but then you don't have to decide exactly which charities all get it in that current year. You can leave the money sitting inside that donor advised fund to be used and distributed out later on. So a pretty powerful vehicle, and each one of these kind of has different and unique aspects to it. Obviously, charitable giving, philanthropic giving, a big part of estate and tax planning. And then this notion of sort of scheduling a family meeting to talk about the goals and responsibilities and bring in sort of those next generations to kind of have these broader conversations. And then make sure that from a financial point of view that there is that holistic planning, that holistic plan of action when it comes to combining these financial your financial and charitable goals as well. That's certainly very key to sort of making it all work. And to just sort of broaden the thought process. Philanthropy isn't just about generosity. It's about creating impact and building family unity and achieving financial efficiency. And so it's so important to kind of weave that charitable planning into your financial strategy to make sure that the difference that you're looking to make could potentially last for generations. So we encourage you to think about that, particularly during the course of this time of year. And as we kind of wrap up this week's program, certainly talked about a number of different topics, from IRMAA to costly 401k mistakes that people make when they're rolling over, to philanthropy. And I think bottom line, there's some key takeaways that are sort of common among all these issues. First of all, you got to stay informed of what the rules are, what the implications are. That's crucially important on any financial decision. Number two, sort of document stuff, right? I mean, if you're going to make a charitable gift, then you need to have documentation. If you're going to challenge an IRMAA decision, then you want to have information to be able to appeal that. Make sure it's well integrated, your planning as a whole. It's not just investment planning or retirement planning. Think about your estate, your tax strategy, your philanthropic planning, and then make sure you're communicating that with family members, and in particular, using expert advice and guidance, because that's a big part of it. These are some complicated issues that we've been talking about on this week's program. So we encourage you to kind of think through all of that during this particular season of giving. Speaking of giving, don't forget our companion workbook to our book, Next Gen Dollars and Cents, is available this holiday season for free, simply by calling the office at 407-629-6477 or visiting our website at Nelson Financial Planning. So make sure you take us up on our free gift offer to you to help you improve your overall financial picture. With that, we're going to wrap it on up and get on out of here. This has been Joel Garris of Nelson Financial Planning on Dollars and Cents.